Daniel and Drake got the exact same tax refund this year. $3,397, almost exactly the 2026 national average. One of them will barely remember it by June. New refund just hit. TV time. The other one is about to be $320,000 ahead of where he'd otherwise be, just from doing one boring thing with that same check. Every year. For a while. Today, what actually happens if you invest every tax refund instead of spending it for 10 years, 20 years, and 30? All growth figures ahead are illustrative, using a historical average return, not a promise of future performance. Start with the actual size of this money. The average federal tax refund in 2026 was around $3,397, up more than 11% from the year before. Close to 70% of everyone who files a return gets a refund at all. Refunds got bigger in 2026, partly because of new federal deductions that went into effect that year. For tips, overtime pay, auto loan interest, and an additional deduction for seniors. For a lot of filers, that meant a bigger check than they were used to. Without doing anything differently, this isn't a small, forgettable amount of money. It's close to what a lot of households manage to save across an entire year, all landing at once in a single deposit. Drake's pattern is common. The refund lands, it feels like a bonus rather than his own money coming back to him, and it gets spent the way a bonus usually does, a little on something fun. A little on catching up bills, and within a few weeks, there's no trace it ever existed. None of that is irresponsible on its own. But it means the refund did nothing for Drake beyond the month he received it, even though, mechanically, it's the same size as an entire year of a small automatic investment for a lot of people. Here's what Daniel does differently, and it's built directly into how you file, not a separate step afterward. The EARS lets you split a refund across up to 3 different accounts, using a form called Form 8888, right when you file. You choose the amount for each account, as little as $1, into any of them, and the deposit is split automatically. You can send part of it straight into a brokerage account or, in some cases, directly into an IRA. Daniel sends a fixed portion of his refund straight into his brokerage account this way every year. He never has to remember to transfer it, and he never sees the full amount sitting in his checking account tempting him to spend it, because it's never all there at once. So what does that actually add up to? Take the 2026 average refund, $3,397, and assume you invest that same amount every year for 10 years, at a 7% average annual return, a commonly cited long-term historical stock market average. Over those 10 years, you'd have contributed a total of $33,970, just adding up the refunds themselves with no growth. Invested the whole time instead of held as cash, that same money grows to roughly $46,900. That's about $13,000 of pure growth, on money you were never budgeting for in the first place. Money that would have otherwise just passed through and disappeared, the way Drake's did. 10 years is a good starting example, but this habit compounds much harder the longer it runs, because the earliest contributions get the most time to grow. Stretch the same yearly refund-sized contribution to 20 years, same 7% average, and the total grows to roughly $139,000. Stretch it to 30 years, and it reaches roughly $321,000, nearly 10 times the total amount actually contributed, purely from letting the earlier years keep compounding. That's the number from the beginning of this video. $320,000, give or take, from a habit that costs nothing extra. It's money that was already coming to you every year regardless. Refunds aren't identical every year. Income changes, withholding changes, tax law changes. This doesn't require investing exactly $3,397 every single year to work. Daniel's rule is simpler than a fixed number. Whatever the refund is that year, a fixed percentage of it goes straight into the brokerage account through the split deposit option, no matter whether the total was bigger or smaller than the year before. The habit is what compounds, not the precision of the dollar amount. One honest caveat before the recap. A large refund technically means you overpaid the heirs throughout the year and gave them an interest-free loan on your own money. The government doesn't pay you interest on it while it holds it. The most mathematically efficient move is to adjust your withholding so less is taken out each paycheck and invest that money throughout the year instead of waiting for it back in one lump sum the following spring. But that requires proactively filing a new W-4 and consistently investing smaller amounts every paycheck, a habit a lot of people, including Drake, realistically never start. If a refund is what actually arrives whether you plan for it or not, investing it automatically the moment it lands is still dramatically better than the alternative most people default to, which is spending it. The average refund in 2026 was around $3,400, and most filers get one. Spent, it disappears within weeks, the way Drake's did. Invested automatically through a split deposit form at tax time, that same habit grows to roughly $47,000 in 10 years, $139,000 in 20, and $321,000 in 30, all from money that was already yours, arriving whether you planned for it or not. If withholding adjustments feel like too much friction, this is the simpler version of the same idea. This video is for educational purposes only and is not personalized financial advice. All growth figures shown use a 7% average annual historical return as an illustrative example. Actual returns vary and are never guaranteed. Refund amounts vary by household and tax year. Verify current refund splitting rules and withholding adjustment steps at irs.gov. If that changed how you're going to handle your next refund, subscribe. New videos every week on the personal finance topics school never covered. Next up, how the ears actually treats you differently depending on how much you make.